G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Alright, let's go. So the topic of this video is to do with the US unemployment rate. The jobs numbers just came out last night, and I said I'd make a new video. I wasn't going to make one last night, like really late, because it came out at 10:30 p.m. I was like, but this morning it's sort of good to get the market's take of it, and yeah, we can go over some people's opinions, some articles, and yeah, we can go over charts and seeing if this is bad news. So the first video we got here is from Radar, CNBC. Just in, nearly 3/4 of the jobs added last month came from government. CNBC, wow. Fake jobs, fake economy, fake president. So I'll just play this video for you.
74% of the jobs came from government and healthcare and education. So that's where the bulk of the jobs are.
Okay.
The rest of the jobs not doing quite so well. Leisure and hospitality, which have been a big source of job growth, just 7,000. Retail, we'd had some strength there, down 8,500. And then temporary help, which is a potential leading sign, minus 48,000. So you have this kind of dual sector economy. By the way, it's not the federal government. A lot of it is local government jobs. They seem to be still hiring in those places or those municipalities. And it's the hospitals up 22,000. So that's where a lot of the job growth is coming from.
There you have it, from CNBC themselves. They can't hide the facts, the data. Some news headlines, they all pump it up. They say, "Oh, you've had 206,000 non-farm payroll jobs." It's great. The labour market is tight, but hearing that from them, one of the notable financial news anchors, not looking good. So on to the next one. Global Markets Investor. How is this a strong economy? The difference between US full-time and part-time employment growth is the largest since the COVID crisis. This is even wider than during the 2001 and early 1990s recessions. Full-time jobs alone declined by a whopping 1.6 million year over year. And you can see there the chart from Fred. We have employed in blue, usually working full-time employed, usually working part-time. So yeah, it's definitely losing full-time jobs, and it's pretty interesting. A lot of people are working multiple jobs just to make ends meet because of inflation. It's taking a toll on other people. So yeah, that's that one. We have David Rosenberg, which is a notable economist guy. The year-on-year trend in full-time jobs is running at minus 1.2%, a big swing from 1.7% increase a year ago and a plus 5.1% 2 years back. This not only represents a significant loss in momentum, but is a foolproof recession indicator. There is nothing soft about this landing. And just talks about full-time employment again, just going back over what I mentioned on the other chart. Same idea. Kabasi letter again, breaking both May and April jobs report numbers were just revised lower by a combined 111,000 jobs. The May jobs report was revised from 272,000 to 218,000, while the April jobs report was revised from 165,000 to 108,000. This means that 10 out of the last 15 monthly job reports have been revised lower. So even the analysts that come out with estimations for the jobs numbers are revising their numbers lower because they don't want to look bad, because it's not looking as good as what they even anticipate. So they're trying to look a bit better, getting closer to the real number. On the net basis, US economy really only added 95,000 jobs this month, Meanwhile, the unemployment rate is now at 4.1% since December 2021. The labour market is slowing down rapidly. Crazy, eh? Wow. And then we have a Zero Hedge article. And I just wanted to go over this sort of chart here, which talks about hourly earnings. So turning on to hourly earnings, here too, there was continued slowing, with the average hourly earnings number rising 3.9% year on year, down from 4.1% in May, and in line with expectations. On a monthly basis, the print also slower to 0.3%, down from 0.4% in May. So from December 2021, you can see a declining hourly earnings. So it's pretty, people are starting to, it's trying to keep up with inflation essentially, and their earnings aren't doing that for them. It's quite staggering. And these guys do really, really good research, Zero Hedge, on different data points, and they covered the unemployment data as well. So very, very interesting article to go over, and what they put out in general is top quality information, and they debunk the myths in the media and the headlines and to make them look good. The media they like to dress everything up like nothing really bad is happening, when underlining data and facts and charts are suggesting otherwise. Okay, so another global markets investor tweet: US recession alert. The SARM rule is an indicator signaling when the US economy is in a recession. If the 3-month moving average of the unemployed rate rises by 0.5 percentage points or more relative to its low last 12 months, it suggests the US is in a recession. It is now at 0.43. So we have 0.07 to go before we hit a recessionary signal. So we haven't hit it yet. That's important to notify. Hasn't hit it yet. So don't get carried away. Even though, it looks like we're shooting up like this, and we're about to approach this line. It's almost destined to hit a recession. We could come down in unemployment rate. So we have to see what the next month's data is to really confirm that we're in a recession. So every other time, you can see there. We'll go over the next chart to really dive into this SARM rule indicator. So this is from Fred, the Federal Reserve of St. Louis. So you can see, going back to 1960, we had a reading above 0.5, boom, recession. 0.5 above, recession. Recession, above 0.5, recession, 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 above 0.5, recession, again, pervasive sickness, and now we are at 0.43, so we're heading that way. So every time, it's worked 100% of the time without fail. So next month's going to be really telling. Even if we stay flat, 4.1%, I do believe the SARM rule will be triggered, and we are identified as being in a recession. So I just want to talk about the unemployment rate real quick. And this is really interesting because in these red shaded areas is US recessions. And going back to the late 40s, 1949, you can see that this white chart signals the unemployment rate. When it rises substantially, and you see the green moving average ribbon, every time it's gone above and turned green, recession. Green, recession. Turn green, recession. Turn green, recession. So, got it there. And we got the 1970 recession. Again, you can see 1980s, back to back, recessions. Again here, 1991, recession. 2001, recession. 2008, just shows it again. So it's very, very, very reliable. And 2020 session, and we're at green now. So we're slowly rising up, and it's only a matter of time before we start seeing these parabolic straight rises up, get these huge increases I've showed here. It's when it really takes off, and it can be stopped, but it takes a lot of time and a lot of rate cuts really to bring down the unemployment rate to ease conditions, so they come back down again, as you can see. So yeah, really interesting data there. And looking at the markets, you can see that Microsoft didn't care at all on the day. We'll just have a look. Boom. Did not care about the unemployment rate. It's up, 1.5%. So it did not care. Apple up 2%. Look at that. See, bad news is good news for the stock market, it seems. It just loves it. It wants to see this bad data so it can get rate cuts. So the rate cuts they see is bullish for the stock market, which generally it is when lower rates do kick in, and it has to come after a strong jobs market and underlying economy, sales and earnings. Everything has to be in the right condition. But yeah, Nvidia is actually down on the day. Got Google up, Amazon up. So it's only a matter of time before bad news becomes bad news. But so far the markets see this as good news because rate cuts are coming. But yeah, I'm not seeing that at all. As eventually rate cuts will come, and it's because of the weakening job market, in my opinion. And you can see the HYG, which is the high-graded bonds, did get a rejection again from this resistance line. So yeah, overall markets are not looking so good. Then you got the stock market as a whole up 0.55%, and the Nasdaq is up 1 whole percentage. All right, guys, we'll leave it there for this video. If you like this one, please smash the like button, comment your thoughts below, subscribe to stay updated, and I'll catch you in the next one. Cheers.